All right, so this is 12-1, looking at bonds payable transactions. What we're talking about with these, excuse me, is obviously with the corporation, we're talking about raising capital by having stock, having people invest in our company. They talk about three different sources. We can use retained earnings, where we put our net income from the year into our retained earnings. We pay out dividends and things. We can always use that money to expand. We can use offer additional stock, like we said, to expand, or we can also borrow money. All right, there's a variety of pluses and minuses that goes along with these ways of expanding and getting extra money. Sometimes business might have extra money coming in, but they want it this year, they want it next year, or they want it sooner than when they project it will come. So they will either have to decide to raise additional cap by offering some more stock or borrowing some money. Like I said, advantages and disadvantages when you're trying to raise money and selling stock and issuing this stock or borrowing. They go through it a little bit here. And so you can read these. The advantages of this is if you issue stock, it becomes a permanent capital, but it doesn't have to be returned right away. You don't have to always give dividends, as it says, unless earnings are warranted by the board to give these dividends out. They might be able to stockpile it a little bit. A disadvantage of issuing more stock is obviously that you got to share it with more people because there's more stock out there, so the dividends will be a little less. Depending on the growth of the company, could be a little more too. Just depends. Advantages of borrowing capital, getting out a loan of some sort, which we're going to talk about as far as bonds. The advantage is your stockholders' equity is not spread thinner because you have additional stock out there. Obviously, the disadvantage of getting a bond or getting a loan of some sort is that you have to pay interest on these. Interest obviously is an extra payment that you'll have to pay but you pay it over time. So businesses will have to figure out the pluses and minuses of that. But usually, when you have to take on extra debt by paying off interest, that will decrease net income to a certain extent. The decreased net income could affect your dividends, obviously, to your stockholders. And then obviously you got to pay it back eventually. Corporations figure this out. That's why they have board of directors, they have CEOs, CFOs. They borrow this money with the idea that it takes maybe a year or two, or a variety of years, 50, 20, 50, whatever the loan or bond is for, over time to pay off. Schools issue bond issues. Um, uh, Companies will issue bond issues. This isn't unusual, but it's something that you have to plan for. Long-term promise to pay a specified amount on a specified day plus interest and stated intervals is called a bond. Okay, they're usually known to be safe ways to invest money. Their bonds are often seen as like a note payable. It's a bond. We're going to use a thing called bonds payable. Um, they could be 5, 10, 20, 50, whatever amount of years, just to kind of depends. Bonds, what we will use this bond issue is all the bonds represented in this loan. So people will buy $1,000 bond, $500 bond, $5,000 bond, and all the bonds that are represented in this is called a bond issue. So a bond is just a long-term promise to you buy. We collect money from people. They buy a bond that we will have to pay back with specified interest later. They talk about this. There's short-term bonds. There's long-term impacts. There's different ideas going about it. So the board of directors will have to issue this. This is different kinds of options with capital stock and bonds that really don't have anything to do with our problem. So basically, we're going to look into this issuing bonds as an option. We've already talked about distributing dividends and issuing stocks, and now we're going to be talking about issuing bonds. This is a big process that can take a while. There's this thing called an underwriter. Company must arrange for securities dealers. This underwriter is a whole industry that are looking at the forecast of the company, where they're at financially, what they're projected to be, and they will help write and set the bonds. How many can they send out, if it's possible to send out, and all the logistics. So the underwriter, again, it's a big process, but the underwriter will be involved in helping the company write these bonds, to issue these bonds. We will issue bonds at face value, not much different than like par value or the the principal amount of the bond. Okay, so the amount paid to the bondholder at the maturity date is called the face value, and like I said, it's not different than par value. Interest rates will be calculated, and that gets to be involved, and they're going to give us the interest rates. We don't have to figure these out or anything, but the interest rates, you might buy a bond at a certain rate, pay and get it at a little better rate or worse rate, just depending on it. And we'll give you one where we buy a bond at a discount and a bond at a premium. And so this interest rate used to calculate these bonds that are issued through this whole process by the underwriter and the company board of directors is the stated interest rate. All right. Again, this process takes a while. You got to plan for it. You got long-term planning, strategic planning for your company. You also got to figure out if people will be willing to do this. If there are investors who are willing to pay these prices. Now, the prices can fluctuate, and this is what they're talking about. If the interest rate is above the stated interest rate, the investors are not willing to pay full price for a bond that yields a below market rate. Okay, so the bonds will be issued at a discount. If the market interest rate is below the stated interest rate, investors might be willing to pay extra to earn an above market rate. That bond is going to be considered a premium. And so what we'll do is we will have two journal entries. One where we issue bonds payable, and it's going to be similar to what we've done in the past, where regardless of what the payment is, the face value is going to be credited to bonds payable. And then if it's issued below the face value, we are going to have what's called a contra account, where we will debit this bond payable because it's issued below the face value, and it's going to be called a discount on bonds payable. Because it's contra account to liability, it'll have a normal debit balance. So the bond payable is a liability, but the discount is a contra account to that, which is weird that discount on bonds payable is still a liability, but it's a contra account to that, so it's seen as a debit. And then obviously we'll get the cash set up with the debit there. So when we have this July 1st, we receive cash for $100 5-year or 100 5-year 6% $1,000 face bonds. So we're going to sell 100 of these $1,000 bonds. They're going to be paid back in 5 years. They issue a yield of 6.2. They get a 5-year 6% rate. When we see this, we see cash that's debited at a lower amount than the bond itself. 100 times 1,000, right? Gets you the 100,000 bond premium at the face value. We'll credit bonds premium at the face value. Our cash amount is lower than that, then we have a discount. And that is due to these interest rates varying. Conversely, if my mouse will work, sorry, and then you can see the T accounts. This difference is debited to the discount on the bonds payable. When they're issued at a premium, then, when the bond is issued to yield an interest rate below the market price, proceeds will be greater than the face value. Then we have what's called a premium on bonds payable, which will be a credit. And you see here, April 1st received cash for $500,000 face bonds. So 500 times 1,000 gets you the face value, which we said was going to be credited to bonds payable. Any amount above the face value will be considered a premium on the bonds payable. So we see here, we know that the bonds payable is 500,000. We're receiving cash of 510,000 and change, and that is above the payable, so we have a premium, which we will credit. Now, we don't have to worry about these. You can see the interest rate varied, so again, we're going to have the premium. So the difference is when we have these interest rates fluctuate, we issue it at 6, it yields at 6.2, they're getting a discount. When it's issued at 6, and it yields 5.5, it's a premium. And those are the two different transactions we will see. I don't believe there's anything here. So when we get to do the problem here, the first thing I like to do is figure out the bonds payable. Receive cash on a 50-year, so you can see it's a 5-year 50 amount, so 50 times $5,000 bonds. So they're selling 50 of these $5,000 bonds at $250,000. That is the face value bonds payable credit. Tells us we're receiving $253,100, and change over here as the cash debit. So when you see that the cash is greater than the bond payable, we have a premium. And you also see that with the interest rate, the yield at 6.7 versus the 7, we get a premium. When you see the bond payable then years later, all right, we receive cash. We're selling 600 of these at $1,000. So the face value, should have just left that there. The face value, hopefully you can understand, we're taking 600 times 1,000, which tells us that we're receiving 595. So here we received more cash. We gave it a premium on the bond. We're giving the discount, which is a contra account to the payable bonds, so that we will have a contra account means we will debit it. And obviously debits have to equal credits. So take a look at 12.1, work through the work together and the application problem, and we'll proceed from there.